Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF conference. I'm here with Ben Johnson, who's head of global ETF research at Morningstar. Great seeing you, Ben.
Glad to be here, Tom.
So there's a lot going on in the industry. This is one of the biggest conferences in the world on ETFs. In your opinion, as you look at the ETF space, what are three of the biggest things going on that you see?
Well, I think what we see is that the ETF tent is getting bigger every year. We saw record flows in 2016. We've got now more than $3 trillion globally invested in exchange-traded funds. What we're beginning to see as we peek inside this tent this year, and I think what people are coming to grips with, is that this is not sort of an evolution in the active-passive debate. We're beginning to realize that all investors are active, and most of the investors here would fall into that camp as well. What we're seeing is that the objects of their active decisions are changing. They're not picking Coke versus Pepsi, they're picking US stocks versus developed ex-US stocks versus EM bonds. And the simplest, the most transparent, the cheapest way to do so is to wrap those securities into an exchange-traded fund, put them up on an exchange, and have them trade all day long. And a bigger number of investors are making active use of these passive building blocks every day.
So really, the benchmarks were meant to be long-term buy and hold for the most part, but now with the proliferation of product and the proliferation of ideas, we're actually seeing more flows, hence more activity.
That's absolutely the case. And what you see too in terms of activity at the product development level is that active is showing up wearing sort of passive clothes. So strategic beta, smart beta, factor funds, whatever you want to call it, is really just an active decision-making framework that's been baked into an index, wrapped up in an ETF, and posted up on an exchange. So active is not dying. As many have said, its death has been greatly over-exaggerated. It's just evolving. Active decisions are migrating. Active decisions are morphing into strategic beta, smart beta, factor investing, whatever you want to call it, which has been the secret sauce of a lot of active stock selectors for years and years and years.
So from Morningstar's standpoint, with all that being said, what's some advice for advisors today, especially who become more ETF-centric?
Keep it simple, keep it cheap, keep your eye on the ball. So there's a proliferation of funds now. We're now at the point where we've got nearly 2,000 ETFs. Yeah. If you rank order those by assets, the 100 biggest have nearly 75% of the assets. They got nearly 80% of the flows. Yeah. So this advice is probably just preaching to the choir, because that's what we're seeing is that people are keeping it simple and keeping it cheap. Yeah. Those 100 largest funds are typically very well diversified. They're very low cost, very tax efficient, very liquid. I expect that this trend will only continue with time.
Yeah, excellent. Ben, as always, I appreciate your sage wisdom.
Glad to be here, Tom.
Thanks.